Alright, ladies and gentlemen, welcome to Lesson 12, Statement of Cash Flows. In this lesson, we're going to understand the important concepts relating to cash and cash equivalents. We're going to learn what goes into the different cash flow statements and or statement classifications, including operating activities, investing activities, financing activities, and then from a given balance sheet and income statement, we're going to prepare a statement of cash flows for ourselves using both the direct and indirect methods. All right, to start, let's go through some concepts and definitions relating to the cash flow statement. You're going to need to have your Lesson 10 cheat sheet in front of you, because you'll see on the back side of that cheat sheet there is the concepts and definitions for Lesson 12, Statement of Cash Flows. So in these three boxes, above it we say the statement of cash flow must include the following three sections as defined by FASB Statement 95. It must include the operating activities, investing activities, and financing activities. So those are the three sections. What goes into each section? Into the operating activity section, you go cash flows and cash inflows and outflows that directly relate to income from normal operations reported on the income statement. Inflows from sales to customers, interest and dividends received. Outflows, purchase of goods for resale and services, salary and wages, income taxes, interest on liabilities. So that's what goes into the operating section of the statement, operating activities section of the statement of cash flows. What goes into the investing activities? There's inflows from sale or disposal of property, plant and equipment, sale or maturity of investments and securities. Outflows related to purchases of property, plant, and equipment, purchases of investments and securities. That's what goes into the investing activity section of the statement of cash flows. What goes into the financing? Typical stuff that are inflows. Typical inflows in the investing financing activities are borrowings on notes, mortgages, bonds, etc. from creditors, issuing of stocks to owners. Outflows, typical outflows are the repayment of principal to creditors, repurchases of stock from owners, and dividends to owners. So those are the three sections of a statement of cash flows, and then the typical cash inflows and outflows that you'll find in each of those sections. Let's move down. We got statement of cash flows. The statement focuses attention on ability to generate cash from operations, management of current assets and current liabilities, expenditures from long-term assets and expenditures for long-term assets, and amount received from external financing. The information you need to prepare the statement of cash flow: you need a comparative balance sheet, an income statement, and there's some additional information. There's regarding certain cash payments, as required. Companies are required to disclose cash paid for taxes and interest, and then significant non-cash investing and financing activities. The statement helps to answer these questions. Is there enough cash to pay short-term debt? Are accounts receivable and inventory adequately managed? Has the company purchased sufficient equipment and other long-term assets? Did the company generate enough cash internally to finance the purchases, or did it rely on external parties for financing? Is the company changing the source of its external financing? Within the financing activities, you'd be able to see how they're, did they get debt? Did they get bonds? Did they receive, the proceeds of stock issuance? That kind of stuff is what the cash flow statement answers. Interpreting the cash flows. So interpreting cash flows from operating activities. Operating cash flows must be positive over the long run for a company to be successful. If they're not generating cash, they're not going to be able to pay, the accounts payable. They're not going to be able to pay long-term creditors. If they're not generating cash, the company can't survive. They're going to go bankrupt. They're not going to have enough cash to pay their suppliers. An upward trend in operating cash flows over time indicates growth and efficient operations. That means management's doing a good job. All right, cash. Now we're going to define cash, although it seems a little unnecessary to define cash. Actually, FASB Statement number 95 defines cash. Cash and cash equivalents are amounts in checking and savings accounts, hard currency, highly liquid short-term investments investments within 3 months of maturity. So it could be an investment. If it's going to mature within 3 months, that means it's almost cash. It's pretty close to cash. That's why it's a cash equivalent, but it's not cash yet. But it's included in cash and cash equivalents. And when we're talking about the statement of cash flows, what we're really trying to do is we're trying to reconcile the changes in cash and cash equivalents, not just hard currency, but these other types of cash equivalents also. So a comparison of the direct and indirect method. Lucky us, we're going to prepare a statement of cash flows using the direct and indirect method for HMS Round Belly. And what we're going to use for the balance sheet and the income statement is in our financial accounting course, we went through HMS Round Belly's operations from preparing a balance sheet, preparing an income statement. We're going to use those income statements from our financial course, and we're going to prepare a statement of cash flows. Whether or not you've watched the financial accounting course or you've purchased it, that doesn't matter, because really you can use the information in terms of comparative balance sheet, income statement. That's really applicable to any company. But that's the information we're going to use. But we're going to compare the direct and indirect method for Round Belly. And so what's the difference? Net cash flow is the same for both methods, right? But the direct method provides more detail about cash from operating activities. The investing and financing sections for the two methods are the same. And that's what you're going to see when we get through and we actually prepare the statement of cash flows. Is investing and financing stay the same, but we disclose different things related to the operating activities, right? Payments from customers, payments to suppliers, instead of changes in balance sheet accounts. All right, so let's get into preparing a cash flow statement. All right, HMS Round Belly. Remember the three things that we needed to prepare the statement of cash flow? We needed a balance sheet, we needed a comparative balance sheet, we needed an income statement, and we needed some supplemental information about interest and taxes, other financing and investing activities. Okay, we're excluding that. But right here we have the balance sheet, comparative. What does comparative mean? We need two periods. We need to compare this period to something else. Comparative balance sheet. So you'll see September 30th, 2010 and December 31st, 2009. We're comparing the two periods. Well, for the purposes of the of Round Belly's statement, you'll see the December 31st, 2009, those balances I made up. I made it up for the purpose of this exercise. But the September 30th, 2010 column, that's the column from lesson 4. We went through and we created that balance sheet through recording the common transactions from lesson 2, lesson 3, and then our adjusting journal entries. So this is the balance sheet recreated. Additionally, the income statement down below is the income statement we created in lesson 2, lesson 3, lesson 4. All right, moving on. The left side of this cheat sheet, it talks about how we go about calculating the indirect method of cash flows for operating activities. Most companies do the indirect method. Why? Because if you do the direct method, you have to include a reconciliation of the indirect method. So if you do the direct method, you have to do the indirect method also. But if you only do the indirect method, you don't have to do the direct method. So you're not duplicating work. Most companies do the indirect method. Just know that. If you're required to do the direct method, you also have to include the indirect method. We're going to go through both, but first we're going to go through the indirect method because that's the most commonly used. All right, how do you do that? You start with net income. You add losses and gains. Remember back to lesson 3, the chart of accounts for Round Belly? We had at the bottom losses and gains, like the peripheral activities, the stuff that was secondary, not part of Round Belly's day-to-day operations. All right, well, in the indirect method, we add and subtract those losses and gains to our operating income before we can get to our net cash provided by operating activity. Also, we add non-cash expenses such as depreciation and amortization. What's amortization? It's the same as depreciation, but it's on different types of assets, like intangible assets or like bond discounts, bond premiums. We've seen amortization before. Remember in lesson 4 when we were doing our closing entries and we booked depreciation? Also in lesson 9, long-lived assets, we were booking depreciation. Well, we add depreciation back for a purpose because it's non-cash. Remember, this is a cash flow statement. This is only cash transactions. So any non-cash, we need to add it back. We don't want to know about it. For accrual accounting GAAP, we need to include it in our balance sheet income statement, but when we get the statement as cash flows, take it out. Moving on, changes in current assets and current liabilities. And then when you add all those together, that equals your cash flows from operating activities for the indirect method. We're going to go through that in just a second. Now, our starting point is calculating the changes on the comparative balance sheet. So we're going to take our column September 30th, 2010, and we're going to subtract December 31st, 2009. All right? So you'll see the far right-hand column of our balance sheet box. It's the difference between the September 30th, 2010 column and the December 31st, 2009 column. That difference is going to go to our statement of cash flows, the indirect method. Remember down here, changes in current assets and current liabilities is included in the indirect method for the statement of cash flows. Well, this is our change right there. Now, I've color-coded. Some are black, some are blue, some are red. What do those mean? Well, go down here to the middle left part of the cheat sheet, and you'll see, recall that the basic accounting equation is assets equals liabilities plus stockholders' equity. All right? From this basic accounting equation, we develop a model to solve the change in cash. Change in cash equals the change in liabilities plus change in stockholders' equity minus non-cash assets. That's the basic equation for calculating our statement of cash flows. So what do we need to do? We need to calculate the changes in liabilities, changes in stockholders' equity, and changes in non-cash assets. All right, well, so we're doing that here on our balance sheet. We're subtracting things like short-term investments. We're subtracting accounts receivable, our current period balance versus the prior period balance, our comparative balance. Now, continue below that box on the left-hand side. It says subtract current balance from prior period to get the change. Changes are treated as follows. And now I've color-coded these. The colors from here are going to match the colors on our balance sheet. So an increase in current assets we subtract from net income. An increase in current liabilities we add to net income. A decrease in current assets we add to net income. A decrease in current liabilities we subtract from net income. All right. Conceptually, that may not make sense why we do it that way. Mechanically, you got to understand that. Down here in this box, current assets, if there's an increase, we subtract it from net income. If there's an increase in current liabilities, we add it to net income. If there's a decrease in current assets, we add it to net income. And if there's a decrease in current liabilities, we subtract it from net income. All right, you'll see that they're color-coded. The blue up here, we're going to add to net income, and the red, we're going to subtract from net income. Now that we've calculated our change, let's go to the statement of cash flows, and I'm going to walk you through how we go down the statement of cash flows with the information we have on this sheet. All right, so the indirect method, remember, okay, the top left indirect method, it says, how do we get to that cash flow from operating activities? We need to start with net income. Top line of our cash flow statement, net income. Where do we get net income? Remember the three things we need to calculate or to come up with a statement of cash flows? Comparative balance sheet, statement of income, and supplemental information. Well, we get that net income from our statement of, in this case it says statement of, our income statement. We get that net income from the income statement. So I've referenced A, goes up here to A. Alright, what's the next thing we do? We add back losses and gains. Well, we didn't have any losses and gains. Going back to lesson 2, lesson 3, lesson 4, we didn't really have any gains. In lesson 9, we had a gain on disposal, but that didn't really get into our balance sheet because that was additional exercise. Lesson 2, lesson 3, lesson 4, we didn't have any gains or losses, so there's nothing to add back. Next thing we do, add non-cash expenses such as depreciation and amortization. Did we have the depreciation? Yes. Remember lesson 4, we calculated depreciation? Alright, so depreciation, $1,500. Where does that come from? We can get that from our income statement. I've referenced B. Look down here to the income statement. B, there's depreciation. We add it back. Alright, what's the next thing we do with the indirect method? We put in our changes in current assets and current liabilities. So